Analysis of AlphaVest Acquisition Corp (ATMV) through Warren Buffett's investment lens. 1. Business quality and economic moat. Analysis. AlphaVest Acquisition Corp Nasdaq ATMV is a special-purpose acquisition company SPAC formed for the purpose of effecting a merger, share exchange, asset acquisition, share purchase, reorganization, or similar business combination with one or more businesses. The company is structured as a blank check company with no commercial operations of its own, instead relying on its management team to identify and acquire a promising private company, thereby taking it public. Through this alternative process rather than a traditional IPO. The company has focused its search primarily on Asian markets, but explicitly excludes businesses with China operations consolidated through a variable interest entity. VI structure due to regulatory concerns. 1.1 Pending business combination with AMC Corporation. AlphaVest has entered into a definitive agreement to combine with AMC Corporation, a security and safety technology solutions company that develops AI-powered products. AMC's portfolio includes award-winning Yi security cameras powered by over 150 AI deep learning and edge computing patents. The company has developed an AI-powered quadruped robot designed as an all-in-one patrol and incident response warehouse solution. The business combination has received shareholder approval and is expected to close in the coming weeks, after which the combined company will operate as AMC Robotics Corporation and trade on the Nasdaq Capital Market under the ticker symbol AMCI. 1.2 Competitive advantages and economic moat. Mover advantage in AI security. AMC's early investment in AI-powered security solutions has resulted in a portfolio of over 150 patents, creating significant barriers to entry for potential competitors. The company's technology portfolio covers AI deep learning and edge computing applications specifically designed for security solutions. Proprietary technology platform. The company's AI-powered quadruped robot represents an innovative approach to industrial security, combining patrol capabilities with incident response functions. This technology has advanced from design to prototype within a year, with testing and validation results showing promise. The company has reported strong early customer interest following product showcases in Japan and Las Vegas. Experienced management team. Following the business combination, AMC will be led by Shengwei Shonda as chairman and CEO, who has demonstrated capability in rapidly bringing innovative products from concept to market. The management team's experience in technology development and commercialization provides an advantage in executing their growth strategy. Despite these advantages, the company operates in a highly competitive landscape with limited economic moat characteristics. The technology sector, particularly AI and robotics, is characterized by rapid innovation and intense competition from well-funded competitors. The durability of AMC's competitive position will depend on its ability to maintain technological leadership and successfully commercialize its products. Table ATMV AMC Economic Moat Assessment using Buffett's framework Moat Component. ATMV AMC Status Assessment Brand Value Limited Brand Recognition Pre-Combination Week. Technology Edge 150 patents in AI security technology moderate. Switching costs integrated security solutions may create retention developing cost advantage. Unproven manufacturing scalability weak, network effects limited evidence of platform effects weak to management, quality assessment, Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. AlphaVest leadership team demonstrates several characteristics that align with Buffett's preferences for capable and trustworthy stewards of capital, though some aspects warrant concern. Leadership experience and track record. AlphaVest is led by CEO David Yan, also known as Yong Yan, who brings academic credentials with a PhD and serves as an independent director of CureNX Pharmaceuticals Inc. However, detailed information about his operational experience and track record in creating shareholder value is limited. The board of directors has an average tenure of 3.7 years, providing some stability, but specific information about their accomplishments and expertise is not thoroughly disclosed. Capital allocation strategy. Management has demonstrated a strategic approach to identifying a business combination target that operates in the growing field of AI and security technology. The selection of AMC Corporation appears aligned with technological trends and market opportunities. The company has also secured $8 million in PIPE financing to support the growth of the combined company, indicating ability to attract capital. Shareholder alignment. Chairman of the board holds a significant 55.2% ownership stake, valued at approximately $30.5 million, which strongly aligns his interests with those of shareholders. However, overall insider ownership information is incomplete, and CEO compensation details are not disclosed, making full assessment of alignment challenging. Transparency and communication. Management has provided regular updates on the business combination process and has filed appropriate supplements to clarify shareholder procedures regarding redemption options. The company has been transparent about the risks and uncertainties associated with the business combination. However, some aspects might give Buffett pause. The lack of detailed information about management's historical performance and the absence of clear compensation metrics make it difficult to fully assess their quality and alignment with shareholders. The SPAC structure itself inherently involves management teams with limited operating history together. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. As a pre-revenue SPAC, AlphaVest's financial profile presents particular challenges when evaluated through these lenses.
3.1 Revenue growth and profitability as a blank check company with no operations of its own. AlphaVest has no historical revenue or earnings track record, Company's financial performance will entirely depend on the success of the business combination with AMC Corporation. AMC has not disclosed detailed financial information in the available search results, making assessment of its revenue growth and profitability impossible. 3.2 Return on equity and invested capital. AlphaVest's financial ratios reflect its status as a SPAC rather than an operating company. Return on equity 2024, minus 165.27%. Return on assets 2024, minus 1.58%. Return on total capital 2024, 140.46%, though this appears to be an anomaly. These figures are largely meaningless for investment analysis, as they reflect the SPAC structure rather than operational performance. Following the business combination, these metrics will need to be reassessed based on AMC's operational performance. 3.3 Debt levels and financial health. From a balance sheet perspective, AlphaVest shows concerning metrics. Total debt equity 2024, minus 64.76%. Total liabilities. Total assets 2024, 109.66%. Current ratio 2024, 0. Quick ratio 2024, 0. These ratios reflect the unusual capital structure of a SPAC rather than operational leverage. The $8 million PIPE financing will provide additional capital to the combined company, but the long-term debt levels will depend on AMC's capital structure post-combination. 3.4 Free cash flow generation. As a pre-operational SPAC, AlphaVest has no meaningful free cash flow generation. The company's cash position will be determined by the trust account funds that remain after shareholder redemptions and the additional PIPE financing. Table AlphaVest Financial Health. Assessment 202 to 2024 * Financial Metric Status Buffet Standard Assessment. Revenue growth, no revenue. SPAC. Consistent growth, NA profit margins negative. SPAC expenses, consistently profitable. Poor. Row 2024. Minus 165.27%, 15% plus very poor ROIC, not meaningful 15% plus NA. Debt. Levels unusual structure, minimal debt concerning free cash flow, negative strong, and consistent poor for intrinsic value estimation. Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life, rather than prevailing market prices. Estimating AlphaVest's intrinsic value presents unique challenges due to its status as a PAC without operations and limited financial information about the target company. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to AlphaVest is not feasible due to the absence of historical financial data for AMC Corporation. Without revenue, earnings, or cash flow information, any DCF calculation would be purely speculative. The company has not provided detailed financial projections in the available search results, making intrinsic value estimation impossible based on fundamental cash flow analysis. 4.2 Net asset value approach. For a SPAC, the net asset value (NAV) per share often provides a floor valuation based on the trust account value. Trust account value, not explicitly stated in search results. Redemption impact. Shareholders have exercised redemption rights. Reducing the trust account value. PIPE financing, $8 million additional capital. Without specific trust account details, the NAV cannot be accurately calculated. 4.3 Relative valuation metrics. Comparing AlphaVest AMC to potential peers is challenging without financial information about AMC. The AI and security technology sector often trades at premium valuations due to growth expectations. But without specifics on AMC's financial profile, any relative valuation would be speculative. 4.4 Market price comparison. The current market price presents a mixed picture. Recent price, $13.50 5-day. Change, minus 34.94% YTD change, plus 19.36%. The significant recent decline suggests market skepticism about the business combination terms or concerns about shareholder redemptions. 4.5 Valuation challenges and considerations. Valuing AlphaVest requires making assumptions about AMC's financial performance. No revenue, profit, or cash flow information is available. Commercialization timeline. AMC's AI-powered robot is not expected to deliver its first commercial version until early 2026. Competitive position. The AI security market is competitive with well-funded players. Redemption impact. High redemption rates could significantly reduce available capital. Based on the available data, AlphaVest cannot be reliably valued using traditional Buffett-style intrinsic value approaches. The lack of financial information about AMC makes any valuation estimate highly speculative. 5 long-term prospects and risks evaluating. AlphaVest's long-term potential requires examining the prospects of AMC Corporation post-business combination, along with various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The AI-powered security market represents a substantial opportunity. Technology trends. Increasing adoption of AI and automation in security applications. Market demand. Growing need for sophisticated security solutions in industrial settings. Innovation. Potential. AMC's quadruped robot technology addresses a niche in warehouse security and incident response. AMC is positioned to benefit from these trends through its patented technology and first-mover advantage in AI-powered security robots. 5.2 Competitive threats and market position. AMC faces competition from several fronts: established security companies, large players with greater resources and customer relationships, technology giants, major tech companies investing in AI and robotics, specialized startups, emerging companies focused specifically on AI. Security applications. AMC's competitive position appears moderate due to its patent portfolio and early technology development. But the company lacks scale and market presence compared to established players. 5.3 Key risks and challenges. Several risks could impact the combined company's ability to compound capital over the long term. Execution risk. AMC must successfully commercialize its technology, with first commercial delivery not expected until early 2026. Funding risk. The company may require additional capital beyond the $8 million PIPE financing to achieve scale. Technological obsolescence. Rapid advances in AI and robotics could make AMC's technology obsolete. Market adoption. Customers may be slow to adopt novel security solutions, like quadruped robots. Redemption impact. High shareholder redemptions could leave the combined company with insufficient capital. 5.4 Capital compounding potential. For the combined company to compound capital effectively over the next decade, several conditions must be met. AMC must successfully commercialize its AI-powered robot and achieve market adoption. The company must achieve profitability and positive cash flows to self-fund growth, or attract additional capital. Management must execute effectively in a competitive market against better-funded players. The technology must maintain relevance amid rapid technological change in AI and robotics. If these conditions are met, AMC has the potential to become a successful company in the AI security space. However, the uncertainty around these factors makes the company's long-term prospects highly speculative and not aligned with Buffett's preference for predictable businesses. 6 Final verdict. Buffett-style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how AlphaVest Acquisition Corp measures up against each of the key criteria. A. Understandable business. The SPAC structure itself is understandable. But AMC's AI-powered security technology involves complexity that may not meet Buffett's preference for simple, understandable businesses. Rating marginal, be consistent earnings. As a pre-revenue SPAC with a target company that has not disclosed financials, there is no evidence of consistent earnings. Rating very poor. C. Goudreau, ROIC. AlphaVest's ROE of -165.27% is dramatically below Buffett's threshold. And meaningful assessment of AMC's returns is impossible without financial data. Rating very poor. D. Low debt. AlphaVest's unusual capital structure and lack of debt information make assessment difficult. But the metrics available are concerning. Rating poor. E. Attractive valuation. The company cannot be reliably valued due to lack of financial information about AMC, making valuation assessment impossible. Rating unrateable. F. Long-term moat. AMC has some technological advantages through patents, but these do not constitute a durable economic moat by Buffett standards. Weak 6.1 overall assessment. AlphaVest Acquisition Corp does not meet any of Warren Buffett's investment criteria meaningfully. The combination of its back structure, the lack of financial information about AMC, the absence of earnings history, and the uncertain competitive position make it completely unsuitable for a Buffett-style investment approach. The company might be appropriate only for speculative investors with expertise in AI and security technology who are comfortable with extremely high risk and uncertainty. Buffett would undoubtedly avoid this investment due to its lack of understandable business fundamentals, absence of earnings history, and inability to determine intrinsic value. For those interested in the technology sector through a Buffett lens, significantly more suitable candidates would include companies with long track records of profitability, strong economic moats, and predictable cash flows, though these would need to be evaluated based on their own merits against Buffett's criteria. Table AlphaVest Acquisition Corp. Buffett-style investment suitability summary. Criterion assessment explanation: understandable business marginal SPAC structure, understandable but AI technology complex. Consistent earnings very poor, no revenue or earnings history good row. ROIC very poor negative row. No data on AMC's returns. Low debt poor unusual capital structure. Limited information, attractive valuation, unrateable, cannot be valued without financial information. Long-term moat, weak some patents, but no durable competitive advantages. Overall suitability not recommended, fails all key criteria for Buffett-style investment.